Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, June 5th, and then we'll see how things look for Thursday, June 6th, in commemoration of D-Day, a very important day in American history. Well, in Wednesday's session, we set an all-time high with the S&P 500. We did it with the NASDAQ 100. And it's really all about one stock and kind of about three stocks right now. NVIDIA is really leading things higher. There was also an economic report that came out that was actually stronger than expected, and the market liked that. We were kind of getting a little bit too far to the side where good news is bad news. Now the market took some good news as good news, and I'll go through that here. We do have the big employment situation report coming out on Friday. We're seeing a lot of additional hedging going on as well. Another slight warning sign is that we still are increasing or going up on a decrease in volume. And that's usually a warning sign that we just want to pay attention to. But as I always say, price is the ultimate indicator. So just know that the SPXInvesting Program has launched. I'm over on Substack. It's free for the month of June. If you want to see a video that talks about the program, please click on this link to watch that video. I recorded it a bunch of times over the weekend, last weekend, and I got tired of that. So I just recorded one video that goes more in depth, and it will be free at least for the month of June. Probably in July is when things are going to start to get locked down. If you want to talk to me about this, I can be contacted by the email address listed here, whether you agree, disagree, like, don't like. If you want to set up a time to have a more in-depth discussion about the program, we can certainly do that. Let's go back and talk about what happened, and then I will go through some charts. Right at the open, we had a gap higher open. The futures were positive. We got above R1 at the open at 53.08. 5,300 had been acting as overhead resistance as we were coming up to that level, getting close to it, and could not seem to break through it. Well, we opened above it on Wednesday. So we then declined to try to attempt to fill the gap, but wouldn't you know, we declined down to 5,300, and that ended up providing support. Now, in the bigger scheme of things, 5,300 is not that important. It's a psychological support level. Now that we've hit that on the way down and bounced up off of it, and then before this, we were coming up to it and couldn't get through it. Now it's developed into more of a technical support and resistance level. As the day went on, we rebounded back above R1 again, climbed to R2 at 53.24. We continued to climb. We never got up to R3, so that's not on the chart. And we closed a little bit above 53.50. We were up 1.18% on below average volume. A concern, we are now positive in the short, intermediate, and long term, but there are still some warning signs. Some of our not necessarily primary indicators, although a few of them are showing this, they're still flashing warning signs, and some of our secondary indicators are also telling us you just want to be a little bit careful here. But nonetheless, the market moved up and set a new all-time high. Of course, we want to keep an eye on the different geopolitical events in case anything has an impact on the market. Some comments. It was a solid up day with NVIDIA jumping up over 5%. It now has a market cap of over $3 trillion. That's kind of amazing. The S&P has set another new all-time high. On a short-term basis, our stochastics, which never really went off the list, well, now it's looking a little more extreme, even with our shorter-term charts. We have the rate of change going back one period. That's just Tuesday to Wednesday. It looks like we may have gone up pretty far, pretty fast, because we were chopping along, not really seeing big gains along the way, and then we shot up over 1%, and the rate of change chart picked that up, and the Williams percent R is now extreme positive. In the intermediate term, the Connors RSI, this is another one. I don't show this one very often, but it's really jumpy on a day in and day out basis, but to get an extreme positive reading is rare, to say the least, and we're seeing one right now. We're also a little bit extreme when we look at our 200-period simple moving average. This is a scenario that I did adjust after Tuesday, where it's looking like and is seeming like the Fed is going to keep rates higher for longer. because inflation hasn't really been coming down to that 2% level the way that they had hoped. If we do have a rate cut, the market is anticipating that to be in September, but that can always change. And this is kind of what helped the market on Wednesday. Economic growth concerns are starting to worry the market. Well, we saw a pretty strong report and the market liked that. So now we're shifting back to good news actually being good news. But too much of a good thing and the party could be over again. We try to really watch for this balance. The dollar was up, which didn't seem to matter to stocks, but interest rates going down, this has given support to stocks. The 10-year yield closed at 4.29%, where it had been at 4.34%. We're still inverted with the yield curves. Sentiment is now up. It ticked up from 41, where it was actually negative, to back into the neutral camp at 46. We're still not trending, but we are positive. Now, when you watched this video yesterday, the red line was on top. With the update that we saw on Wednesday, the green line is now on top. So it is defaulting more to positive. But as this adjustment is taking place, the ADX is still below 20 and it's still below its moving average. With the update, we're positive and our momentum is now positive. We've had 3 up days in a row, but Monday and Tuesday were like minuscule. It was really Wednesday where we saw the up move here. We did get the weekly MBA mortgage applications index. It was down 5.2%. Last week, it was down 5.7%. The ADP employment change came in weaker than expected at 152,000. They expected 175,000. Last time it was 188,000. This is the area that the market is really starting to focus on now. If we see a tick up in unemployment, if we see the jobs numbers start to be lower, if we see numbers like this one come in weaker than expected, the JOLTS job openings and things like that, if we start to see a pattern there, that might induce the Fed to be more inclined to cut interest rates. But if we go too far in that direction, that could really suggest an economic slowdown. The S&P Global U.S. Services PMI, the final reading came in at 54.8. That's above 50, so it's showing growth there or expansion. Or last time it was at 51.3. This was the big one, and it came in stronger than expected. The ISM non-manufacturing index came in at 53.8, again, above 50, showing expansion. They expected 50.7, where the last time we had this report, it was under 50 at 49.4. So we've gone from a contraction reading in the last time we had this to now showing an expansion. Here's a chart. Here's showing the ISM services. The blue line is the total, where we had dropped down below 50, and now we're coming back up. Prices are actually coming down, and taken together, the market really liked that. The MBA mortgage applications were down on the week, but not quite as much as what we saw last week. The ADP employment change, you can see where we're continuing to drift off here, but we're still showing that there are more jobs available than people to fill them. Here's some Isabel Net blog charts. This is, and I like how when people say arithmetic, okay, it's arithmetic. It's what we took in school. It's the average annual return of the S&P 500 over different periods. This is just for information. We're looking at 15.57% if you go back to 2017 to 2021. Of course, right in the middle of that was the COVID plunge. We also had the plunge here from 2009 to 2021. And this is just to look at and go, ooh, isn't that interesting? Then looking at the daily candlestick chart with the moving averages, this is different than how I prepare things. The fact that we got right up to this level and then started to come back down, they call this an outside day, and there's all kinds of things that can be read into this. Of course, now we've been able to break back above this high that was set in May 23rd. So we're kind of breaking above what this chart was trying to suggest could be negative. The 10 largest companies as a share of the total S&P 500, and this keeps going up all the time, it seems. We got 35%. These are the big companies where their earnings are 26% of what we see. And then what is the recession probability indicator looking like now? It has been coming down. It ticked up just a little bit, but we're still seeing this really dropping off. And then positions in equity futures by asset managers. This is stocks. and they are net long here and probably even longer now that we had the big update on Wednesday. And then looking at the global valuation over here on the left, this is the US, and this has probably gone up as well. We're up over 20. Even looking forward, when we get above 20, that means the market is expensive, and that's where we're at right now. And then you can compare that to other countries across the globe. And I show this every week in the weekly video. This is the Shiller PE, cyclically adjusted PE ratio. It's also looking very overextended. And these are the readings that we've been seeing, and I go through this every week. And by sector, communication services saw the biggest inflows and tech saw the biggest outflows. Well, kind of wishing they had Wednesday back now. But we're seeing total outflows according to Bank of America on this chart, where if we're seeing money coming in, it's going into communication and discretionary, where we're seeing a lot of money right now coming out of tech. But this can change really quickly. Small businesses hiring plans typically lead the unemployment rate. So this is what we're looking at with this red line actually going down, but yet the unemployment rate is still pretty small. Are we going to see something similar to this? Actually, it's going up just a little bit. This is an inverted chart here. These two tend to really follow each other. So which one's going to lead? Cyclicals versus defensives. This is what we watch when we look at growth versus value, discretionary versus staples, where the cyclicals have been outperforming, but not really showing a real strong leadership role. I was actually kind of surprised looking at this chart based on some of the charts that we look at. I did find a few interesting charts on Twitter. The $3 trillion club, Microsoft, Apple, and NVIDIA make up 20% of the S&P 500. These are the big boys, and everybody's just kind of NVIDIA crazy now. During the tech bubble, this is what I'm also seeing at times, people posting, well, what we're seeing right now is just like the dot-com bubble that we saw back in 2000, and things are just going to crash and they're going to be terrible. Well, not if you look at the fundamentals and what's really driving the market higher. Over here on the left, we saw a real disconnect between price and earnings back in 2000. You had companies that were dot-com companies that had no earnings, yet their stock was at $300 per share, and everything got really out of whack. Where if you look over to what is happening now, we're seeing them more in line with each other. There's not a real disconnect. So is this time different? Now, first of all, is this time even different? It looks like what we're going through right now is different than what we saw in 2000. But since we're shooting higher and prices are going up, people want to try to make the comparison between the two. According to this, everything is not really playing out that way. But we always want to be aware, nonetheless, there can be other forces that come in and act on the market. Goldman sees a wall of money fueling stock market summer rally. Well, this might not be all that encouraging. When they come out with rosy headlines like this, they see a lot of retail investors really wanting to get in the market over the summer. And then here's our intraday chart where we gapped above R1. We came down. We never got quite down to the unchanged level, but we did fall back a little bit. And then we bounced back up. We got above R2. We never did get up to R3, and we closed at the high for the day, just a little above 53.50. Here's our intraday chart where the futures had been strong and just kept being strong. We just kind of carried everything out as the day went on. We're up a little bit in the initial overnight session. We are seeing growth outperforming value on an intraday basis, looking at this 10-minute chart. And this is also showing an improvement, the intraday chart of growth versus value for the S&P. Our end-of-day charts show where growth was up really big compared to value, even though both were up. We also saw growth up for the mid caps and outperforming value for the mid caps as well as the small caps. So it was a growth kind of day where value had been doing a little bit better, at least earlier in the week. Well, now growth came in and kind of took over. So we're seeing a little bit of an improvement here with our small cap growth to value ratio. It did tick up, but we're not really breaking out at this time. Also a bit of a tick up with mid cap growth to value and a bit of a advance here with S&P growth to value, but not a real leadership role that we would really like to see. We are looking a little better here when we compare growth to value with these ETFs. We came all the way down to the rainbow. We bounced up, and we're continuing to bounce up out of the top of the rainbow again. But when you look at discretionary, yeah, it was up, but it's not really breaking out right now. And again, if you look at the chart all by itself, it's not that discretionary was up, it's that staples were down, and that's why this ratio really advanced. Large cap growth hitting a new all-time high. The Wilshire also hitting a new all-time high. It does look like the 50-day moving average for the Wilshire was what the support was that helped us bounce up off of that. Here's our trend where we switch back over to positive with the green line on top, but the ADX is still below its moving average and both are below 20. So we're still in a non-trending environment, but where we had been defaulting to negative with the red line on top, now we're defaulting to positive. And we're seeing that same type of thing here with our shorter term ADX chart. And we're dropping off with volume, not really an encouraging thing when we're setting all-time highs, but seeing volume taper off. Sentiment, we're going up just a little bit here with the Ulcer Index, but still below the moving average. We did get the latest reading as of June 4th. We're at 3.16. Now, this was about a week old now, so this actually dropped off a little bit, but it's still above 3. Here's the VIX. The closing value with the line chart did decline, and we're also closing near the bottom of the bar when we look at the bar chart. With the update, the volatility of the VIX did decline, both with the bar chart and the line chart. But the momentum of the VIX continues to be up. Now, since we had an update and the VIX fell and we're below 13 again, that tends to be positive longer term. The MACD is rolling over, but it hasn't crossed over at least yet. Equity put call ratio, we saw this spike up. Possibly some hedging going on ahead of Thursday and Friday sessions. A lot of people buying puts, they're not really trusting what's going on here. And so when we look at our 5-day chart, we're continuing to go up, which tends to be negative for the market. Volatility risk premium is still pretty high right now. Even though it did come down, we're still above the band. We did decline with this fear gauge. We actually ticked up a little bit here with this other fear. Now, I guess we ticked down just barely, but it's kind of hard to see with this other fear gauge. We're seeing a slight improvement here with the advanced decline line based on price. Although we're setting a new high up here on top, we have not set a new high with the advanced decline line based on price. We are setting a high based on volume. And this is what I've been noticing over the last few days. Volume tends to be leading price, and that can be positive. We did see an expansion of the new highs, but not enough to turn our 5 period back up, and our 10 period is still declining. And believe it or not, even on an update, we saw a slight increase of the new lows. We are back above zero with both the 19 and 39-day advanced decline ratio. So that's turning back positive. This is one of the more positive charts. Accumulation distribution is above the moving average and going up. This is a smart money indicator. The chicken money flow is going up, another smart money indicator, and the chicken oscillator is going up. We get a little nervous if we go above the red line. We get really nervous if we start to go above the green line. The cumulative NYSE advanced decline line did go up, and we also saw just a little bit of a tick up, but not all that big of a deal when we look at the NYSE regular advanced decline line. And we ticked up slightly with this other NYSE advanced decline line. So we're not seeing much broad market participation, at least yet, and we didn't see it in Wednesday's session. Here's the common stock for the NYSE based on price, where it ticked up based on volume. See, we're not really breaking out all that much right now. We are going up with the cumulative S&P advanced decline line based on price, but we're showing more strength based on volume. That can be positive. With our advanced decline line studies, we're turning back up with the NYSE common stock, S&P, mid caps, and small caps. Here's the daily chart where we're pretty much above or still below resistance and above support here, where we almost came down to the 50-day moving average, and we were able to bounce up off of that. On the bottom, we are below average with volume. Here's the one-day rate of change, just going from Tuesday to Wednesday, where we might have overdone it, but we could still go even higher than what we've seen here. The Williams percent R is starting to look extreme positive. We don't know yet if this is a cause of concern or just showing good solid momentum, but none of our other short-term indicators have gone extreme positive yet, except for the CCI 14 is now extreme and the CCI 20 is now extreme. Again, we'll just have to really look inside to see, okay, is the market becoming overextended or are we seeing good momentum here? The short-term stochastic really jumped back up to extreme positive. We're going back up. It's still below the midpoint with the intermediate term. We never did stop being extreme positive in the long term, and now we're starting to turn back up there. This is something I've been pointing out here where it would have been more positive if we could get back above the blue and the green line. Well, we did that in Wednesday's session. So this is showing that the short term is looking more positive according to this chart. We did turn up with the 20, 50, and we're flat with the 200 period moving average study. We want to see this doing a little better. It's kind of lagging a little bit here. But the force index is positive. It's above zero and advancing. We're still above the 20 period moving averages. We were able to get back above those. So the short-term trend is still positive. We're coming up into the +2 channel of our standard deviations chart. If we continue to go up, we might get into the +3. That's when we've gone up a little too far, too fast. But we don't say that right now anyway. The balance of power actually declined on an up day. It was right at zero, and now it's actually dropped slightly negative. We're positive with the go, no go with the darker blue bars. We're coming up to the highest high value. If we can stay up here, we'll see the blue line start to go back up. The TTM squeeze is starting to flatten out just a little bit after it had been declining and turning darker blue. If this could actually start to go back up, that would be more positive. And we're looking better here with our double and triple exponential moving average based on 50 periods, where we're kind of playing around for the last number of sessions, either just a little bit below or inside both of these moving averages. Well, we broke out in Wednesday's session. Here's the Connors RSI, where we're seeing an extreme positive reading. The 50 period, just keeping an eye on this in case weakness develops. We're positive with the ease of movement, and we're going back and looking more positive with the Erin. But here's where we're seeing a warning sign. We're still below zero with the S&P McClellan oscillator. It did go up, but we need to see it cross back above zero. So with our summation index based on price and volume, we're still continuing to decline. Now you can see a little bit of a flattening out based on volume. These are two separate indicators from each other. If volume is actually leading things, we would want to see the volume actually flatten out and turn and go up even before we see price turning back up. And that could be happening now. We're also still negative with the NYSE McClellan oscillator. We're below zero, although we did advance. So we're declining with the NYSE summation index based on price and volume. This is another big improvement here. The Swenlin trading oscillator. We crossed back above zero based on price and volume. And this has gone from being negative back over to positive now. Momentum trying to turn back up a little bit here with the PMO, but we haven't quite started to turn up when we break it out based on price or volume. The PMO studies, we are going back up with the PMOs that are rising, barely ticking back up with the buy signals, and still declining to flattening out with the PMOs above zero. We have turned and remained positive for the last 2 days with the Elder's Impulse system for the S&P. This is a biggie. The parabolic SAR, we saw enough of an advance for the dot to come underneath. This was a real concern, but it's now switched from being negative back over to positive. The slope oscillator still negative, but trying to turn back up. The MACD also trying to turn back up. So our oscillators are still pretty much declining in the short term, even though they're starting to turn back up a little bit here. Seeing a little bit more of a turn up here with the PMO. With the tricks, our longer term oscillator, we're right on top of the moving average, and we're also on top with the KST. We're above all the plotted moving averages here. So that is positive. This is finally looking a little bit better. The bullish percent index was above 50, so it was positive, but it had been declining. We finally saw it tick up. Now, it didn't show an awful lot of strength, but for the first day in a number of days, it's actually going higher. We're still declining with the NYSE bullish percent index. We're still declining. Did I say that? But we're above 50, so it's positive. This is a concern too. The NASDAQ 100 bullish percent index. It did tick up, but it's still below 50, so it's negative. When we look at the money flow, kind of flat right here, but still above 50. The ultimate oscillator is positive. The vortex, after coming right down to the red line, has now been bouncing back up, so that's positive. We're looking better with the RSI 14 and the RSI 9, and we're not necessarily extreme, at least yet. On balance volume is positive. The stock's above their 20 period moving averages. Yeah, it turned up, but didn't really break out, and it's still below 50. So this is another warning sign that we're watching. Our study isn't showing an awful lot of follow through with the 20-period moving averages, at least yet. The 50 period also ticked up, but is still below 50. So that's more intermediate term negative and a warning sign. We turned up a little bit with stocks above their 100 period moving average, and we actually declined with stocks above their 200-day moving average. That's kind of a concern for the long term. Now it can fix itself, but to see the S&P set an all-time high and see the 200-day moving average study actually go down, that's kind of concerning. The cockpit curve is still negative. The Sean trend meter did bounce up and is not quite extreme positive. We're above all the lines in this little mini rainbow. And if we stay above this, I'll probably stop showing this chart for a while. Looking at our trend, though, the Heiken Ashi is positive. The Kagi chart is positive. The Renko is positive. And the three-line break is positive. Long term, we're still below this level with the 150. And we actually declined, but we're still extreme positive with the 200-day simple moving average study. And we think we set a new cycle here on June 4th. Well, we'll just have to see if that leads to anything. But this is a non-confirmation here. And I've been pointing this out on an as-needed basis and usually over the weekend. When you look at the equal weight S&P and the equal weight QQQs, which is the NASDAQ 100, we're not setting all-time highs with these, where we are with the regular indexes. So to see things more solid, we want to see these setting new all-time highs as well. We're not getting a new Hindenburg-Ullman, at least another spike, at least yet. We are still negative with the mid caps in the short term, but everything else is now turned to positive. And we're looking better with bonds in the short and intermediate term. We're still negative in the long term. Commodities are negative in the short term. And the dollar, which is showing a little more weakness, is now negative not only in the short term, but also in the intermediate term. No changes here on the decision point card, decision point scorecard. And we saw an awful lot of blue or green here. Canada even got into the party where we got above 5,300. We're seeing a lot of NASDAQ crossing above levels. We're seeing tech having a bullish percent index above 50. We also saw the BPI for the NASDAQ cross above 50, and we set a new all-time high with the S&P. So, and then we have I guess we crossed below 50. So it was a little teaser here. We broke above and then went down below. The sectors, we saw tech and communication. These are the two big areas, and they were leading things higher on Wednesday, where we saw real estate, staples, and utilities negative. These are the defensive areas that we've been watching, and they were down on the day. Looking at the equal weight, we're seeing really where the big stocks are still continuing to outperform. Now, that's not necessarily a bad thing, but in a good, solid environment, we want to see the whole market participating, not just the big monster stocks. The Dow is still having a difficult time getting back above its 50-day moving average and this pivot point. It was only up 0.25%. And we still remain neutral with the Elder's Impulse system for the diamonds, where we're breaking to an all-time high with the NASDAQ, and we still have a ways to go to hit this R1 level if prices keep going up. Also a ways to go before we get to this R1 level if we keep going up with the NASDAQ 100. We are positive with the NASDAQ 100 with the Elder's Impulse system. We're trying to switch back over positive with the momentum. We're coming back up, but right on top of the moving average currently. The Qs, when looking at our moving averages, yeah, we're above all of them, so that's positive. The small caps were up 1%. They came down to their 50-day moving average and bounced back up and are just about at this pivot point. And we've actually switched from being negative over the last few sessions to positive for the small caps when looking at the Elder's Impulse system. We're just a little tick above 50 when we look at the small caps based on the Russell 2000. This is the RSI. We were able to get back above the 50-day moving average, but the shorter-term momentum continues to be negative. The mid-caps also having a difficult time getting above their 50-day moving average. And if they do that, we have a pivot point above current price. And we switch from being negative back over to neutral for the mid-caps when looking at the Elder's Impulse system. Apple up 0.78%. Could be getting ready to show a golden cross if prices can stay above these moving averages. Tesla, who's up a little bit, 0.13%, still really struggling overall. NVIDIA just shoots to the moon and beyond here, just setting new high after new high. Microsoft was up and broke above its 50-day moving average. Meta was also able to get above its 50-day moving average. Amazon still below its 50-day moving average, but up over 1%. Google was up 0.93% and still looking pretty solid. Netflix was also up 2.95% and still above its 50-day moving average. The FANG index is setting a new closing all-time high, not necessarily an intraday high. The financial sector was up 0.25%, but still is hanging around its 50-day moving average. We came down a bit here with the staples to tech ratio. We want to see this continue to fall to stay positive. The dollar was down, but we're still in a longer-term uptrend the way that I measured it here. And not really any change when we compare the world index to the S&P 500 index. The staples sector, they were actually down 0.23%, but still above their 50-day moving average, still in a longer-term uptrend. The utilities were down 0.58%, but still have been really strong lately. Healthcare was up 0.44%, another defensive area that we're watching and is still in an uptrend. Energy, which has been declining, it was unchanged on the day. The total U.S. stock ETF is setting an all-time high. So this broad market measure is showing more broad market participation. We keep falling now with the 10-year yield, and that's really what's giving support to stocks. So we're going up with the 10-year based on price. We're still looking like we're going to have a soft landing according to what the market thinks will happen, according to this chart here. And we're back to declining here with the bond to stock ratio. When this is going down, that means bonds are underperforming. To say it another way, that means stocks are outperforming. And when we look at the broad market, the S&P 1500 to shorter term bonds, we're breaking up again outside of the rainbow. That's positive. Another broad market measure is also coming back up out of the top of the rainbow. The tech sector also coming out of the top of the rainbow. So Dorothy must really wonder where we are over the rainbow here. The Qs are also breaking out above the rainbow when we look at 3 to 7 year bonds. We're seeing a bit of an improvement here with the Qs to S&P ratio. We're not seeing an improvement with discretionary to the S&P. We are turning back up when we compare large cap growth to large cap value. So the large caps are improving, a little bit of improvement with the mid caps, but we're still below a declining moving average. We got above the moving average with the small caps, but we want to see more follow through here. We're still off of setting extreme positive readings here, but if we can hold on to these gains and see even more, this will likely go up over the next few sessions. We're seeing an improvement here with our 19-day advanced decline ratio. We got back above zero based on price and volume, and we're a little bit higher here based on volume with the reading. The S&P to utilities ratio, yeah, it ticked up, but we want to see more of a trend going up to give the S&P more support. And we came down with the staples to S&P 500 ratio, but we want to see this really continue to fall to give more support as well. So what are we looking at for Thursday? The technicals, we are positive, and strength is re-entering the market, but there is weakness that's still there that we have to respect. The McClellan oscillators, the summation index, some of the warning signs that I pointed out, these are things that we need to have taken care of if we're going to be more positive on the market. We do have positive seasonality, especially going at least the next few days here. We're going to get the weekly jobless claims. We're going to get productivity and the unit labor costs, the trade balance, and then we want to keep an eye on all the crazy things in the world. And then Friday is going to be the employment situation report. So jobless claims are kind of the biggest thing in Thursday's session. Seasonality, we are positive for June 6th with the Dow, S&P, and NASDAQ all looking good. Going back to 2002, Thursday tends to be a positive day, at least based on what happened in 2023. Looking at the Stock Traders Almanac chart here with the green dashed line, we do have a few more days of positive seasonality going until about the 10th or so of June. This is also suggesting a little further out that we could see positive seasonality for the S&P. We could also see a little bit of choppiness here for the NASDAQ and then a little bit of strength in July. It's really near the end of July or early August during an election year when we see some seasonal strength. And according to Tom Bowley, we're still in this positive period right now before we enter a negative period. So the warning signs, we're still a little bit concerned about this all-time high, not that was made on Wednesday, but that was made a while back, where staples and utilities were very strong. Now they're still strong, but they're not really moving up like they were a while back. We just want to keep that in the back of our mind for right now. We're also keeping an eye on energy and healthcare, because these, not so much energy, but healthcare is more defensive. And I'm trying to color code these a little bit because I seem to think these are more important. Our growth to value ratios, as well as discretionary to staples, that ratio, they're not leading right now. They improved on Wednesday, but they're not really busting out. The equity put call ratio has turned back up. And then our McClellan oscillators and summation indexes, they are negative. These are really important indicators, at least as far as I'm concerned. Our oscillators, they're turning negative. Now, we could see a little bit of an improvement, but we need to see some follow through. The Copic curve is negative, and the 20 and 50 period moving averages, they're still below 50, and they are negative. And the bullish percent index for the NASDAQ 100 continues to be negative. And then I have a new little thing here just to kind of go through this. I suppose I should have put this on the animated part. But the parabolic SAR, this is to me a primary indicator. It's gone from being negative to over to positive. The Swenlin trading oscillator, the reason why it's yellow, it's kind of a primary indicator. It's like a weak primary indicator and a strong secondary indicator because it has led us astray at times. The bullish percent index for the S&P accumulation distribution, Chaikin money flow, and Chaikin oscillator, these are all positive. And I actually should have moved the bracket down. What I'm trying to show here is that these three, accumulation distribution, Chaikin money flow, and Chaikin oscillator, I tend to treat these as one unit. And that's what I was trying to do here, but obviously it didn't work out. The money flow is positive. The ultimate oscillator, the vortex, another indicator that I consider to be kind of a weak primary, strong secondary indicator. It is positive, and the financial sector is positive. And we're just barely looking positive with the momentum for the NASDAQ 100, where it's coming back up to its moving average. So our conclusion, we're positive, and strength is coming back, but these weak areas are still causing us a concern. Now, the market does like to climb a wall of worry. And if everything is all pointing green at the same time, that's when we usually have topped out. So it doesn't necessarily mean doom and gloom. We just want to be aware of these things. And we do have positive seasonality. We're seeing that same thing pretty much in the short term. The weakness is a concern, but we are positive. And in the long term, we also continue to be positive. Thank you. I really hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.